Okay. So now let's try to understand interest coverage ratio. This is an important ratio which the companies and the banks always use whenever they are lending to some other people. So this ratio simply tells us what are your earnings before interest and tax, and that needs to be divided by interest expenses. So the earnings before interest and tax is important because this is the money available with the people, after which the interest will be paid to the bank. So let's go and try to see our EBIT, what we call it, and our interest expenses in our PNL or balance sheet. So we are going in our I can say PNL here, and this is our PNL here, and here we can see our net income before taxes is given as $80,000, but this is before taxes, but interest expense has already been reduced out of it. So we need this amount before interest. So basically we are saying this $80 is after interest, and interest was $10 here. So before interest it would have been $90, right? So before interest, our earning before interest and tax or income before interest and tax was $90. Then interest got reduced of $10. Then we are having $80 here, which is available for as a net income before taxes. Now these are the numbers here, and if we go below and see here, so here if you can see your $80 was there, $10 was there, and your interest expense was $10. So effectively this is showing your earning before interest and tax was 90, your interest expense was 10. So this is giving you the result of 9 times. Now what does this 9 times simply means? This simply means that you are able to pay your interest expenses 9 times compared to what you are having right now. So this is a good indication for bank. It's like if your interest expense is $1, then your earnings available to pay the interest expenses and other things is $9. So banks would be very willingly, happily giving you the money because they will be able to get their interest, right? So why the companies use it? So the companies use it to check the credit worthiness. Lenders use it before approving loans, definitely. Then this also helps in financial risk assessment, whether the debt load is manageable. If the debt is very much increasing, the interest component will increase, and if the interest component will increase, this ratio will be decreasing. So it ensures whether the debt is manageable or not. Also, investors prefer companies with strong coverage because it reduces the bankruptcy risk. If let's suppose the company is having this 1:1, which means that if the company is having it 1:1, interest is 1, and corresponding to that company is having earnings of only $1. So in that case it would be very difficult for the company to give out the taxes and to give the earnings to equity shareholders and other people. And finally, it is used for the strategic planning for management to decide if they can take more debt or not. If they want to take more debt, they go and check their earning before interest and tax or EBIT. Now in real world, what happens this, uh, people call it as total interest earning ratio as well, TIE ratio. In Apple's case, this is 20 times. Why? Because Apple earns massive profit relative to its small interest expenses. This similarly shows the extreme strong debt serviceability from the Apple, that they are able to repay their interest and debt very quickly. If we see the case of Ford Motors, so auto companies often have lower ratio, lower debt to equity. Why? Not debt to equity, sorry, interest coverage ratio, which is 3 to 5 times, because they carry large amount of debt for manufacturing and financing operation. So if they have large amount of debt, then that large amount of debt creates large amount of interest, and that large amount of interest makes this ratio lower. Ford must carefully manage debt to avoid liquidity issue, especially during downturns. If we see the airline companies just like United Airlines in the downturn like COVID-19, this ratio fall below 1. Why this fall below 1? because at that time the flights were not running and their EBIT was very low. But even though EBIT was low, they had to pay the interest, right? Because interest is a mandatory payment. So when this became mandatory, this ratio of interest coverage went below 1, and this was a bad situation for them. That's why airline companies need government bailouts and refinancing. So in multiple instances in past, you must have heard that this company has been bailed out by government because the company was not having money to run its operation or pay its interest. So this is a key ratio which is used in companies and across other institutes as well.